Trump's new write-off rules. High-income retirees must act now. A quick note before we dive in. Ads may play during this video. Your support keeps this content free. Now let's jump in. Imagine for a moment that after decades of disciplined saving and careful portfolio management, you discover that a simple oversight in your tax planning has effectively handed over 40% of your future growth to the Internal Revenue Service. For high-income retirees, the rules of the game have not just changed, they have been completely rewritten under the latest legislative framework. Most investors are still operating under outdated assumptions, but for those with significant traditional IRAs, 401k, and concentrated business interests, the reality is a looming fiscal cliff that could devastate your long-term capital allocation. There is a specific window of opportunity closing right now, and if you are sitting on a substantial nest egg, the difference between proactive wealth management and passive waiting could be the most expensive mistake of your financial life. The landscape for write-offs and deductions has shifted in a way that favors the aggressive but punishes the unprepared. While the headlines focus on broad tax breaks, the real value lies in the sophisticated mechanics of the new tax code that the general public often overlooks. We are seeing a fundamental restructuring of how the federal government views high-income retirees and business owners. The thresholds for the top marginal brackets have been adjusted for inflation, but more importantly, new deductions for seniors and business owners have been introduced that create a high-stakes environment for your taxable income. If you are not careful, a single large distribution or a failure to document your new write-offs correctly could push your effective tax rate into a territory you have not seen since your peak earning years. Let us pull back the curtain on the new senior deduction and the enhanced write-off rules. For the current tax year, the standard deduction for married couples filing jointly has risen to $32,200, but that is only the foundation. For those over 65, a brand new senior bonus deduction adds up to $6,000 per individual, or $12,000 for a couple. However, this comes with an aggressive phase-out. If your modified adjusted gross income exceeds $150,000 on a joint return, this benefit begins to vanish at a rate of 6 cents for every dollar over that limit. This is a classic example of the shadow tax. It is not a rate increase on paper, but it is an increase in your actual tax liability. To solve this, you must master the art of liquidity management. Are you pulling from the right buckets at the right time to keep your income below these critical phase-out thresholds? This brings us to the second principle, which is the institutional-level optimization of the state and local tax deduction, often called the SALT cap. For years, this was capped at a measly $10,000, which penalized retirees in high-tax states. The cap has now been dramatically increased to over $40,000. This is a massive win for property owners, but it is a strategic window that requires precise timing. If you are a business owner or an investor with pass-through income, you should be looking at the permanent extension of the 20% qualified business income deduction. This is a sophisticated move that allows you to shield a significant portion of your income from federal taxes entirely. By layering the new SALT limits with permanent business deductions, you are not just saving on taxes today, you are performing essential capital allocation that keeps your wealth working for you rather than the government. The third principle is perhaps the most critical for high-income retirees, and that is the transition of catch-up contributions into Roth accounts. For those earning over $145,000, the Internal Revenue Service now mandates that all catch-up contributions to your 401k or 403b must go into a Roth bucket. While this removes the immediate tax deduction, it creates a massive long-term wealth-building opportunity. By paying the tax now, you are effectively buying a tax-free future for your compounding assets. This is where most retirees fail. They focus on the immediate cost rather than the long-term value. When you combine this with strategic Roth conversions for your existing traditional IRA balances, you are performing a risk mitigation strategy that protects your estate from future tax rate hikes. Let us look at a real-world example of how these write-off rules can change the math for a high-income household. Imagine a retired couple with a $5 million portfolio and $200,000 in annual income from a mix of Social Security and IRA distributions. Under the old rules, they might have simply accepted a high tax bill. But by utilizing the new $10,000 car loan interest deduction for a personal vehicle and the expanded $2,000 charitable deduction for non-itemizers, they are already cutting deep into their taxable base. If they further utilize tax loss harvesting to pair their gains with realized losses in their taxable brokerage account, they are not just performing simple bookkeeping, they are engaged in high-level wealth management. They are effectively manufacturing their own tax breaks to keep their modified adjusted gross income below the levels that trigger expensive Medicare surcharges and Social Security taxation. So what are the specific, implementable steps you should take right now to act on these new rules? First, perform a comprehensive tax projection for the upcoming cycle. You need to know exactly where your income falls relative to the new 37% bracket, which now kicks in at $768,700 for married couples. Knowing your position allows you to manage the timing of your capital gains and IRA distributions to stay within the most efficient tax bands. Second, if you are a business owner, audit your equipment and research and development spending. The new rules allow for 100% bonus depreciation on equipment and a full expensing of domestic research costs. This is a massive write-off that can essentially wipe out your tax liability for the year if timed correctly. This is not about spending more. It is about the strategic timing of the expenses you already plan to make. Third, review your charitable giving strategy in light of the new floor for itemizers. Starting now, itemizers must have their charitable contributions exceed 0.5% of their adjusted gross income before they can benefit from the deduction. If you are close to that line, you should consider bunching your donations. By making 2 or even 3 years' worth of contributions in a single tax year, you can soar past the floor and the standard deduction, maximizing the value of your gifts while significantly lowering your tax profile. Finally, investigate the new child savings accounts if you have grandchildren or young dependents. These accounts act like an IRA for minors, allowing for tax-deferred growth on up to $5,000 in annual contributions. This is a powerful tool for estate planning and wealth transfer that bypasses many of the traditional gift tax complications. It allows you to shift capital into a lower tax environment while building a lasting financial legacy for your family. In summary, the new write-off rules are not just a collection of minor adjustments. They represent a fundamental change in how high-net-worth individuals must approach their finances. From the new senior bonus deduction and the increased SALT cap to the permanent extension of business write-offs, the opportunities for tax optimization are immense. But these rules are complex and often temporary. You must balance your current liquidity needs with the long-term preservation of your capital. By understanding the interaction between these new deductions and your overall capital allocation, you can move from a position of tax exposure to one of financial security. If you found this analysis valuable, Please click the thumbs up button to give us a like as a thank you for this content. We upload fresh videos on these high-stakes wealth management subjects regularly, so make sure to subscribe to the channel so as not to miss our next deep dive into tax efficiency and retirement planning. I would love to hear from you in the comments. Share an idea from the video that you plan to implement, or let me know if you have questions about how the new senior deduction applies to your specific portfolio. Your engagement helps us continue to provide this institutional-grade advice to our community. As a final reminder, I am not your financial advisor. The information provided in this video is for educational purposes only and does not constitute professional tax, legal, or investment advice. Every financial situation is unique, and you should seek the counsel of a qualified fiduciary or tax professional before making any significant changes to your wealth management plan. Thank you for watching, and I look forward to seeing you in the next one.